lot of you are concerned about a possible recession, 2023. The markets will crash in the years 2023. What if, however, there is no need to fear over that? This is your chance to take advantage of the fact that more wealth is made during bear markets, as you are undoubtedly aware of. Not just your financial position is holding you back from reaching your objectives. It isn't how much time you have. The level of intentionality is the issue. It is going to have the right goal. To make 2023 the best year ever, you must devise a plan. We discuss market fundamentals and what is behind the slowdown in GDP growth. We discuss the distinctions between a fractional reserve system and a fiat money system. What a powerful monetary system would look like in terms of free banking, gold, and Bitcoin. We talk about its interactions with the Bitcoin community and how quickly innovation is spreading at this stage of the market cycle. Why the likelihood of another recession is 99%. The fundamentals of the economy are incredibly shaky, and most people aren't aware these principles might influence the standard of living in society as a whole in the future. They'll also watch CNBC to hear the suggestion to just buy the dip. You know, they will discover the portfolios are 60-40, or what the economy is performing well. No question then, the information is uncontested. There are the makings of an unstable economy, and the situation is only getting worse. They do not, however, match the market. You start off by talking about the recession. Either the economic crisis or the asset's declining value were mentioned. I also utilized the 1-year and 10-year yields to measure how frequently recessions are predicted by those two maturities by examining the yield curve between those two maturities. If my memory is correct, there have been 11 official recessions since 1950, and the inversion of the 1 and 10-year curve predicted 10 of those 11 recessions. By the way, we have never had a recession without the 1 and 10-year curve inverting. These individuals would be correct if they looked at 1965, the year we had an inversion, a rather big inversion of the 1 year and the 10 years, but no official recession. Perhaps there is some wiggle room there, but if you study financial history, you may already be aware of this fact. Between 5 and 10 months after the inversion in 1965, real GDP growth dropped from 10.1% to 0.2, not 2.2. Impact is the same. So that's simply for when we're discussing the 1 and the 10. Now, if you look at the yield curve as it is right now, it's not only the 2 and 10, the 1 and 10, or the 6 month. The interest rate that the Fed establishes as a floor for interest rates across the board in the economy. Thus, the Fed controls the discount rate. It has a repo in addition to IOR, which is essentially like Fed funds. Thus, there is typically a spread of 20 to 25 basis points. The reverse repo is currently at 3.8. So, why is this a floor, even if it is only theoretical? Since the Fed is stating that you can park your money here like a money market fund and we will give you a risk-free 3.8%, you can do so. It poses no threats. Why then would anyone choose to invest in any other asset with a yield below 3.8? It's a notion of nature. The yield curve, however, currently informs us of how bad the economy is. Because of all the economic inefficiencies, bad investments, and resource misallocations generated by the government, the 30-year Treasury is currently trading below the yield on the 3-year Treasury, below that 3.8% that the Fed sets as a floor for interest rates in the entire economy. Is the Fed genuinely in charge of regulating interest rates? And I would contend that it is sufficient proof that it is manifestly untrue. However, things are not doing well right now. You get the idea. I could go on to mention the inversion and the Eurodollar future curve. And the 3.7% unemployment rate is the only foundation on which the bulls can stake their claim. Or, I suppose, they might claim that the CPI has decreased from 8.2 to 7.7. However, I would counter that just because the CPI is declining, it doesn't always indicate that the economy is booming. Consider the Great Depression. After that, the CPI significantly decreased. Yeah, by the way, during the global financial crisis in 2008, the CPI drastically decreased. Yeah, but was that really beneficial for the markets or what? These are therefore the key dynamics. The point of inversion on the curve was between the 1-year and 2-year mark. Thus, anything trading below the 1-year mark or with a maturity more than 1 year was yielding less. Therefore, the point was something between a year and a 2-year period. As maturity progresses, you're going to notice that the point on the curve is getting shorter and shorter. So, the inversion between 1 and the 2 has just begun. The 1 month will trade higher than the 3 month as it moves from 6 to 1, and then all the way up to 32. As a result, you observe very little demand and possibly net selling from the public sector, and the data dissects this. I wish I could recall the terminology they employed, but reading the report makes it quite clear. This implies that all central banks are not sellers of treasury securities at the long end. Additionally, private organizations like hedge funds in Japan and pensions funds are net buyers. You see, a lot of liquidity is being provided by it. Domestically, you won't have that much liquidity, relatively speaking, because it's evident who won't purchase a 10-year treasury bond at 3.6% while inflation is at 7.7%. So, you must ask yourself, why are these private investors buying treasury securities in Europe or Japan? Why are they actually influencing the market's demand side? Well, it's because the value of the dollar has been steadily rising. Therefore, if you're a Japanese investor or pension fund, you probably don't care that the US inflation rate is 7.7% because your liabilities and expenses are denominated in yen rather than dollars. So, why wouldn't you buy a 10-year treasury bond at 3.6% if the dollar is rising in value by 10% compared to your obligations as long as the yen, or excuse me, as long as the dollar is rising versus the yen and appreciating, and you're betting that it's going to continue in that direction? The risk is therefore what would happen if the dollar started to decline. So what happens if the Fed starts to change its stance and the dollar drops from its current level of, say, 106 or something? The dollar will, hypothetically speaking, go from rising up in value forever to going down in value relative to the yen forever, for those public or private investors who are located outside the United States. Let's suppose it drops straight to 95. They then turn into net sellers of treasury bonds. And in my opinion, that's where you can encounter serious liquidity problems at the long end of the curve. Because those T-bills are used as collateral, the supply and demand dynamics are very different at the short end of the curve. So in essence, will there be a smooth landing? Yes, I'd guess it's probably 1%, 80%, 20%. We're going to land gently. 80% we're going to land harshly. And so, to answer your question, I would say that we will see a soft landing due to X, Y, and Z if I were to make the bull case for the stock market. In other words, all of these interest rate increases that we've seen from the Fed take time to spread throughout the economy. Adam Taggart, a good friend of ours, frequently cites the pig and the python as an example. The economy will absorb the interest rates we've had over the past 6 months over the coming 6 months, which will gradually reduce inflation from 7.7% to say 6% to 5% to 4%. In this environment, where the Fed is no longer concerned about inflation, they can proceed with stopping interest rate increases. And if they stop increasing interest rates, risky investments will once again take the lead. As you may also be aware, the stock market will rise and the value of currency will fall. And you know, when the CPI gradually falls below the Fed's 2% objective rate, we're all going to hold hands and sing Kumbaya from now until the end of time. Yes, that would seem to be the ideal situation. Whatever conclusions you come to, just remember that there are no certainties, is my main message to both your community and mine. Nothing is certain. And that's the main issue I have with the Bitcoin space, or a lot of them, because they talk about certainties a lot. However, the same thing applies to gold bugs, albeit in my opinion to a much smaller extent. Looking at this chart, however, you can see that the parabolic growth precisely corresponds with the expansion of the Eurodollar system, or this extremely very elastic money supply. Thank you so much for watching this video. If you like this video, please hit the like button.